Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Ross, daily we're inundated with realtor comments about a house being the best investment you can make. We all know that that's been true the last few years, but how should we really be looking at our homes today?
Well, I agree with the first part of that statement. I do believe that homeownership wealth, is the most stable way of building net wealth over your lifetime that exists today. The nature of homeownership, in other words, the reality of being a homeowner automatically sets into place certain steps, certain actions, a certain lifestyle that leads you to build wealth through your home. Where I disagree is where people are relying upon house price gains. In other words, rising house prices to justify the legitimacy of home ownership in terms of an investment. That just sort of defies logic. And if you know how a housing market functions and the relationship between equity and debt, you know that relying upon gains is okay in a declining interest rate cycle, but relying on gains in an increasing interest rate cycle simply makes no logical sense at all. When we're looking at something like British Columbia, Jim, when I'm looking at my stats right now today, I know that as of September, the average homeowner in British Columbia who's owned their house for the last 25 years, they would have looked at somewhere around a 5.4% annual gain in their home's price. 5.4%. I also know that 5.4% is predicated on falling interest rate cycle. I know that going forward on a rising interest rate cycle, the current homeowners, people who are entering the market today, they will not be able to have the same reliance on house price appreciation that those people who bought 25 years ago had. So how you structure your home ownership situation will need to be totally different if you want to build net wealth in your property. I'll explain it to you this way. Anyone who believes that the average price in British Columbia will be $2 million, 25 years from now, clearly has no understanding about mortgage payments, mortgage qualification, income required to facilitate owning a $2 million property. That simply is something that is impossible in a rising interest rate cycle. You need to understand how these components interact together to understand what your forecast is going to be. In other words, do I look to own 7 years? Do I look to be an owner for 10 years? Do I look to be an owner for 25 years? These are key questions that you have to answer, because if you're relying on house price appreciation to build net wealth over the next 25 years, while sitting there passively and doing nothing other than owning your home, taking care of it, renovating it, repairing it, you are not going to see the same gains those who have owned a home for 25 years are now experiencing.
So what's the future of home ownership? Should people dip into it? Do they wait?
Well, I'm asked this question by, people who have kids in their 20s, and they're saying, should my son or daughter, or they're getting married, they want to start out in home ownership, should they buy real estate? Well, my answer is quite simple. Yes, you should buy real estate, and you should buy it as quickly as possible. On top of that, you should buy the most expensive real estate that the bank will qualify you to buy. And you should continue to own the most expensive real estate you can afford to, the bank will qualify you to own, right on through till you're about 55 years old. And at 55, you need to start having a little bit different strategy. The reason for that, Jim, is because I know that you will pay off your mortgage. In other words, it's a forced savings plan and nothing more. It is the most awesome forced savings plan ever created. It's a savings plan for a bank account that you can actually live in. And when you sit back and you look at it as it's simply a way of saving your money and having that money protected against inflation, because worst case scenario, that's what you're going to see. Your house price will, worst case scenario, will at least keep up with inflation over the next 25 years. There is no other way for you to save that money, and your net cost of owning that home, in other words, versus renting, is going to be way less than it would have been had you rented and attempted to save the money. I'm often asked the question, Ross, we're buying a house. Like I was asked this question hundreds of times early in my career. Young first-time buyers looking to buy a house. We'd like to buy a house, and but we don't want to buy too much so that we can still afford to take a trip down south once a year. Well, you know something? That trip down south once a year may be really fun. I wonder whether or not you could take that vacation at home as a staycation is what they call it now. But, we advocated for that 30 years ago because we know, especially in 2017, the cost of that vacation, the cost of that 1 week away down south versus applying that same amount of spend on your home. In other words, buying a more expensive home. So I'm not going to spend the $5,000 with taking the wife or the wife taking me on a holiday down south. I'm instead going to make that $5,000 part of a larger mortgage so I can buy a more expensive home, so I have more home equity that I can build over my lifetime. That vacation can cost the family an incalculable amount over 25 years, Jim. Now, I'm not saying don't take the holiday. I'm not saying don't drive a nice car. I'm not saying don't do this, don't do that, don't do that. You shouldn't live a constrained life. But what you should do is you should understand if you want to trade your current pickup up for a new pickup truck, you're going to take on an extra $20,000 in debt to do so. How much that $20,000 could have generated had you purchased a different property and put that $20,000 you're going to spend anyways in your personal residence. Remember, personal residences are capital gains free. You pay no income tax when you take the money out of your house. Zero. Other than your TFSA, which to me, and in our strategies, are now part of owning a home. The TFSA now is an addition on your house. So your listeners should understand that. The way that we look at it is the TFSA is now just an addition that has been added onto your house, and that TFSA room is now part of your home ownership strategy. If you had filled that TFSA up, instead of taking that trip down south, you have no idea the wonderful life you're going to have 25 years from now.
We'll have more with Ross Kay right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test the numerous targets located by recent groundwork will commence later this year. Please visit our website at rmroyalty.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're chatting with Ross Kay. Ross, last Friday, the Canadian Real Estate Association released their review of the Canadian housing market for September with a headline, Canadian home sales edge up again in September. Royal LePage in the same week said house prices were surging forward and the market was getting hotter. How did your firm assess September's data?
Yeah, you hit on a lot of points there, Jim. In terms of the housing market, that Canadian housing market has been cooling since last October as a national market. Okay, so your listeners need to understand this. Contrary to popular belief that it has filled the halls of Canadian banks and economist classes in every university across the country. There is such thing as a national housing market. There always has been. That national housing market is made up of provincial housing markets. Those provincial housing markets are made up of regional housing markets, which are made up of municipal housing markets, which are made up of community housing markets. The truth of the matter is, all of those community housing markets in aggregate form a national housing market. There is this myth out there that what happens in British Columbia doesn't necessarily happen in Quebec. Well, I'm telling you, Jim, that is another falsehood. There are certain market metrics that work the same no matter what part of the country you're in at the same moment in time. That's why we call it a national market. So we know that the national market right now is trending below 500,000 resale homes being sold this year. And when we do our work on the calculations, we're looking at around 470,000. So the Canadian Real Estate Association will be announcing somewhere around 500,000. We know that a large component of that is actually new homes, not resales. So we know the number is going to be actually lower now than it has been for this will be 3 years. 3 years when you comparing apples to apples, 2017 will record fewer sales than were recorded in Canada in 2012. Apples to apples. That is your national housing market. We also know at the national level in September, because of the impact of provincial markets on the national market, that the average price of a house, the average home buyer in Canada was spending about $1,500 more a month in September than they were in August. Now, you're not going to hear that anywhere, but that's simply the truth. Did the market, based on the headline you quoted from Korea, inch up or increase in September? No, it did not. What Korea does is they try to cherry pick some statistic that can put a positive spin on their members earning commission. To earn commission, you must sell houses. What they've done is they've compared September against August. They didn't compare this September against last September, where we see a staggering drop in home sales. I mean, Ontario, we're looking at, I think we're around 26% lower this September versus last September. They're just comparing it against August. But this is how real estate sales representatives, organized real estate boards and associations, real estate companies like Royal LePage, who you commented on with the Royal LePage house price coming out with these crazy gains that they're claiming. That's where they're coming from. That's their view of the market, because it puts forward the narrative that they want, which is to buy houses. Royal LePage uses what's called a median price, which they fabricate themselves. There is no data out there that people can use to verify these medians. And what I will tell you is, from our data, these medians are ridiculous. They are based on a flawed model from the 1970s or 80s that they're still trying to uphold today, because they sell this data to corporations through their ownership group, the Brookfield Asset Management. Brookfield owns Royal LePage. But Royal LePage, as a corporation, it makes money by renting out desks to real estate agents. It's not like the old days, or even like 15 years ago, where the real estate brokerage only made money if his real estate agents, sales reps, sold houses. He got a cut of the commission. That doesn't happen anymore. The sales reps that are in that office pay a monthly desk fee. They rent a desk, they rent an office, they rent a part of the secretary, they rent this answering service, all from the broker. The broker's businesses now are solely reliant upon renting desks out to as many agents as possible. The only way you can do that is by having a positive narrative. Thus, the Canadian Real Estate Association release, thus the Royal LePage release, thus even RE/MAX has gone to that format. You'll notice in none of those reports is a home buyer ever referenced. Not once. In not a single report issued is the buyer side of the transaction supported. All of your listeners in British Columbia who have believed this false narrative for so long, that has led in 2017 first-time buyers going out into Vancouver and overpaying for condos, because that's what the real estate agents could sell in 2017, have been taken advantage of by this system. These metrics that the real estate boards release are hogwash. They are nonsense. They are not backed up by data. They are simply a fabrication of everyone involved in the real estate sales business to generate sales commission. The average selling price in Canada dropped. The real price of a home dropped in September. You got to remember, there's house price inflation, folks. If your house price isn't going up by a certain amount in the province that you're located in, it means you're losing money. It's just like inflation. There's inflation and there's house price inflation. House price inflation is substantially greater than good old everyday inflation that Statistics Canada calculates. These metrics that both of these organizations you cited, Jim, in your question, they are both false metrics. They have never been correct. They are part of the reason you have a housing bubble. There are standard homeownership strategies, standard homeownership metrics that you need to have before you buy a house. Do not buy a house without them. Because I'm telling you, folks, take my word or not, this is free advice, the housing market is changing. It's changing radically. And over the next 2 weeks, it could be very well change in a way that would not have happened had proposed changes not been put into place by the government. Those metrics from Korea, Royal LePage, are false metrics. They cannot be supported with data. I can sit in front of any independent body where the economists from Royal LePage, Canadian Real Estate Association, or anywhere else sits with me, and I will destroy them. They do not know what they're talking about. It's false.
We'll have more with Ross Kay right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Ross Kay. Ross, on Monday, a major research firm released a report stating that mortgage credit growth will drop to 4.5% a year if mortgage qualification rates hit the uninsured mortgage market. They claim this would drastically pull back GDP growth. You've said on occasion economists don't really understand how much of the nation's GDP is being powered by the housing market. How would you interpret this suggested mortgage debt forecast?
I see another economist or group of economists or research firm who is now, after the fact, coming out with a forecast designed to grab attention. So I'll explain it to your listeners this way, Jim. There is what's called mortgage rollover. So we do a calculation on the national mortgage debt every single month. These calculations are rooted in how the market is functioning at the time. It's a computed value. It's a forecastable model. It tells us what's going to happen with the amount of mortgage debt outstanding. What your listeners need to understand is that as mortgage debt is being added through the sale of properties from one person to another, whether it's a builder to a new to the first buyer of the home, or it's from existing owner to another owner, the new owner, there is mortgage debt that is going to be associated with that. And that is going to take place for the foreseeable future, unless all of a sudden our country starts to shrink instead of growing in terms of population. You've got to add new houses. You've got to move up the property ladder. That's just the reality of how life has been in Canada for the last 50 years. What this research paper, because I know now the one you're talking about, I think they were saying it was at 6.7, it was going to drop to 4.5% annual growth rate of mortgages. These guys don't understand how the national, this is another statement, the national mortgage book currently sits at. We know what the national mortgage book sits at. What is a mortgage book? A mortgage book is all of the mortgages from all different homeowners that are being scrutinized. So it could be Royal Bank has a mortgage book. Okay, they have mortgages for the last 25 years from their clients, and how those 25 years of mortgages, whatever's left on the one that was booked 25 years ago, how much mortgage is left in the one book 5 years ago, how much mortgage is on the one that was just booked this month. That's what's part of a mortgage book. There is also a national mortgage book, provincial mortgage book, and a municipal mortgage book, just like the market. These mortgage books are all functioning differently at a given period of time. You can't just make some crazy supposition that because a new rule change is going to take place, that's going to impact mortgage book growth. Mortgage book growth is dependent upon how the mortgage are structured in that mortgage book. In other words, if I have a mortgage with 5 years left on my term, I am paying down so much principal every month, it's staggering. If I have a brand new mortgage, I'm paying down that principal at a lower rate, although in 2017, it's still phenomenal. It's still awesome. But if I had the mortgage book in 1990, I was paying off next to nothing on my principal every month. So I would know that my mortgage book is going to grow way, way quicker than what it's growing today. People have no understanding how much new mortgage money must be booked each month in Canada in order for the mortgage, the amount of mortgages to continue to grow. The magnitude of that, Jim, the sheer magnitude of the amount of mortgages that need to be booked just because of how quickly the current debt is being paid off. People don't understand this. And that's what this report showed. because our metrics show it is highly probable that mortgage rollover will take place where national mortgage debt begins to decrease. You cannot keep adding on more mortgage debt quickly enough so that you don't get negative gain. It is a mathematical and income impossibility that if you have the right forecasting model, you know where it's going to be reached. And you know what velocity the housing market had to stay on in order for that mortgage growth to continue to stay positive. It is simply a staggering number, Jim. Like when we look at it, it's a staggering number. See, we look at the entire Canadian housing market just like we look at it for each single person who's a member of the Wealthy Homeowner Program. We look at their mortgage debt in the exact same way. We chart it in the exact same way. We make recommendations to them in the exact same way. So if we can do it for one, we certainly can do it for the 3.5, 4 million mortgages that are out there, because we have the data that shows how that mortgage book is functioning at this moment in time. What I can tell you is that research, that headline, the news, the coverage that group garnered from that report was not earned. They made a guess based on a change to the mortgage market that they believe will happen. They haven't taken into all the other considerations I just spoke to you about.
Ross, thank you so much for chatting with us.
Thanks a lot, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. You're listening to HoweStreet.com radio. Any questions for the show or our guests can be sent to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.